Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024, February-March, Paper 3-2, question number 2. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. KPLC's financial year ends on 31st December. An inexperienced bookkeeper had prepared a draft statement of cash flows for the year ended 31st December 2023 by only comparing the balance of each item in the statements of financial position for the years 2022 and 2023. We have been given draft statement of cash flows for the year ended 31st December 2023. Okay, the first thing we can do is figure out which of the items should be included within our corrected statement of cash flows and which items should be rectified. So the first one we have is increase in non-current assets at cost. Remember that we cannot include the increase. Rather, we need to include the purchase cost of any new non-current asset as well as the sales proceeds of the disposed non-current asset. So this would be incorrect. Then we have the increase in provision for depreciation, which is again incorrect. We have decrease in inventory. That is correct. We will include this within our operating activities section. We then have increase in trade receivables. That will also be included within our operating activities section. Then we have the decrease in trade payables, which will again be included within the operating activities section. Then we have the increase in accrued loan interest. So this will not be included. Rather, this will have to be adjusted as part of the interest paid within the statement of cash flows. Then we have the increase in ordinary shares. Okay, so the increase in ordinary shares can be included under the heading of proceeds from issue of shares, but we have to be careful whether the issue is a bonus issue or rights issue or new issue. There can be 3 different types of issues, right? So bonus issue, rights issue, and new issue. And since we're talking about the statement of cash flows, we only need to consider those issues which would bring additional cash into the business. That will be rights issue and new issue. Remember that bonus issue will not bring any sort of cash into the business because we would be funding all of the new shares from our existing reserves. So we do not need to include the proceeds from bonus issue. We will only be including the proceeds from rights issue and new issue. So for this one, we first have to make sure that this increase is only of the rights issue and new issue. And so is the case with the increase in share premium as well. Then we have the increase in retained earnings. Remember, we do not need to include this. We would rather include the profit from operations within our operating activities section. So this is incorrect. Then we have increase in 8% loan. So the increase in loan just means that we have now issued additional loan of 10,000. This will result in additional cash inflow for the business. So we do need to include it, but we can maybe change the heading under which we can include this within the financing activities section. Then we calculated the net increase in cash and cash equivalents, added it to the opening balance of cash and cash equivalents in order to get the ending balance of the cash and cash equivalents. Now, information for the year ended 31st December 2023 is also available. The following balances were on 1st January 2023. So all of these will be our opening balances. We have the opening balance for non-current assets, both the cost as well as the provision for depreciation. We have the opening ordinary shares, share premium. This will be important so that we can determine whether or not this increase in ordinary share as well as the increase in share premium is due to the rights issue and new issue or the bonus issue. Then we have been given the opening retained earnings balance. I think this one will be important in order to calculate the profit for the year because we have not been given any information regarding that for now. Then we have the 8% loan. So this is the existing loan at our opening date. And then during the year, we acquired additional 10,000 loan. Then we have the accrued loan interest. This is the opening balance. All right. So this will again be adjusted in order to get the finance cost. For the second information, a new item of office equipment was purchased. So we know that there is a purchase of new non-current asset, and in order to calculate the value of the purchased non-current asset, we can use our schedule of non-current asset involving the net book values. And this was purchased in order to replace the equipment which was purchased in 2021. Currently, we're talking about the year 2023. The equipment disposed of. So we also had a disposal which had a carrying value of 9,000 at the date of disposal and was sold for 6,200. Okay, so for this one, I think the first thing we can calculate is whether there was a profit or a loss on disposal because we have the net book value, we have the sales proceeds. In this case, we can clearly see that the sales proceeds is lower than our carrying value, which would result in a loss on disposal. And the value for loss is just going to be the difference between the net book value of 9,000 and the sales proceeds of 6,200, which is of 2,800. Then it is a company policy to depreciate office equipment at 20% per annum using the straight line method. A full year's depreciation is charged in the year of purchase, but none is charged in the year of disposal. Okay, remember that we require 4 different things whenever we are preparing the statement of cash flows. So the first one will be the depreciation charge for the year, which in this case we are yet to calculate it because we only have the increase in provision for depreciation. So the first thing we need to calculate is depreciation charge for the year. Then if there is any sort of disposal, we require the profit or loss on disposal, which we have already calculated right here. Then if there is any purchase, we need to calculate the purchase value of the new non-current asset, which we are yet to calculate. And the fourth one is the disposal value or the sales proceeds of any disposed non-current asset, which is given right here to be 6,200. So we have 2 information out of the 4 information that we require. Now remember that we can solve for 2 values using 2 different equations. But usually whenever we calculate the depreciation charge for the year or the purchase value, we always used to follow our schedule of non-current asset involving the net book value. But in this case, we require 2 different values, the purchase as well as depreciation. So it will be impossible to calculate both the values using only one equation. Now the next thing we can do is utilize our schedule of non-current asset, but for provision for depreciation in this case. Because remember that our schedule of non-current asset will have 3 different sections. One for cost, one for provision for depreciation, and the third one for net book values. So I think we can first calculate the depreciation charge for the year using our provision for depreciation. Okay, so this one is again the schedule of non-current asset, but only remember the provision for depreciation or the accumulated depreciation part. So what we do, okay, I'm just going to write down the accumulated depreciation here. So this can be regarded as accumulated depreciation schedule. What we do is we start with the opening balance of our accumulated depreciation. Then if there is any disposal during the year, we also need to eliminate the disposed accumulated depreciation now. So this will be elimination on disposal. Then we need to add the depreciation charge for the year. And this will give us the closing balance. Now, remember we also require the accumulated depreciation of the disposed non-current asset. So let's calculate that first. We know that this disposed equipment was purchased in 2021. And according to our company's policy, a full year's depreciation is charged in the year of purchase, but none is charged in the year of disposal. Let's create a timeline here. This is 2021, 2022, 2023. Remember that we purchased that equipment in 2021, so we need to calculate the depreciation for this year. We need to calculate the depreciation for 2022 as well. And we are now disposing that equipment in the year 2023. And according to our company policy, none is charged in the year of disposal. So we do not need to charge any depreciation in the year 2023 for this disposed equipment. Now we also know the net book value of the disposed equipment is 9,000 at the date of disposal, which is after 2 years, right? Right here during this year, the net book value is 9,000. Now remember, net book value is just the difference between cost and accumulated depreciation. And accumulated depreciation for this particular equipment is just going to be the sum of depreciation in the year 2021 and in the year 2022. Because accumulated depreciation is just the sum of depreciation since the year of purchase till the current date, right? It means that accumulated depreciation is going to be the depreciation charge for 2 different years. And we know that the depreciation policy is 20% per annum using the straight line method. Okay, let's incorporate this. So we know that the depreciation charge for 1 year will be cost times 20%, since we're talking about straight line method. And for 2 years, we can just multiply it by 2. Now we can easily calculate the value for cost from this equation. If we take the cost common, that will be 1 minus 20% times 2 will be equal to 9,000. It means that the cost of our disposed equipment will be 9,000 divided by 1 minus 20% times 2, which results in the value of 15,000. Now we can easily calculate the value for our accumulated depreciation using this particular equation. So we can substitute the value for cost, that is 15,000, minus accumulated depreciation will be equal to 9,000. And we know that the accumulated depreciation will be equal to 15,000 minus 9,000, which results in the value of 6,000. So this is the accumulated depreciation of our disposed equipment, and that is the value for elimination or disposal. Now let us include the opening balance of our accumulated depreciation, which is the provision for depreciation itself. That will be 195,000. Now we are trying to calculate the depreciation charge, and for the closing balance we can take a look at our increment. The increment value is of 22,800. Now it just means that the closing balance is 22,800 higher than the opening balance. So we just have to increase the opening balance by 22,800. So 195,000 plus 22,800, which results in the value of 217,800. That's the closing balance of our accumulated depreciation. Now the depreciation charge for the year will be 217,800 minus 195,000 plus 6,000, which will be equal to 28,800. Now we've successfully calculated the depreciation charge for the year. The last thing we need to calculate regarding our non-current asset is the purchase value. Now we can use our schedule of non-current asset, but for the net book values. We know that we always start with the opening balance, add the purchase, subtract the disposed net book value, subtract the depreciation charge for the year, and get the closing balance. And remember that all of these are the net book value. So we first need to calculate the opening net book value. And remember that net book value is just the difference between cost and accumulated depreciation. So at the opening date, we have the cost of 325,000. And at the closing date, the accumulated depreciation is of 195,000. So the opening net book value is of 130,000. We're trying to calculate the purchase value. The disposed equipment had the net book value of 9,000. So we subtract it. We calculated the depreciation charge for the year to be 28,800. Now for the closing balance of the net book value, we first need to calculate the cost, because we know that for the closing balance we need to increase the opening balance by 33,000, and we know that the opening balance of our cost was 325,000. Now we're increasing it by 33,000, which results in the value of 358,000. Then we need to repeat the same process for accumulated depreciation, but we've already calculated it right here. That will be 217,800. Now the net book value at our closing date will be 358,000 minus 217,800, which results in 140,200. Then the purchase value is just going to be 140,200 minus 130,000 plus 9,000 plus 28,800, which results in the value of 48,000. Okay, that is all for our second information. For the third one, loan interest of 1,600 was paid. Alright, and for dividends, 22,000 were paid. That is all for the given information. Let's take a look at our first question. We need to explain one reason why the information in the statement of cash flows of a business is important to its shareholders. Alright, remember that the statement of cash flows will show the sources of internal financing as well as the external financing, which will help the shareholders to assess the viability of the business. So that is one reason why the information is important to shareholders. Let's write it down. The statement of cash flows shows the sources of internal financing and the extent to which the business has relied on external financing which helps the shareholders to assess the viability of the business. That's all for the first part. Now for the second one, we need to calculate the profit for the year for 2023. Remember what I said before, we can use the information regarding retained earnings in order to calculate the profit for the year. And we can just use the format for the schedule of changes in just the retained earnings column. So we always start with the opening balance, and in this case there is no bonus issue, so we do not need to worry about any funding towards bonus issue. The only changes within our retained earnings will be made due to the profit for the year, we always add it, and due to dividends payment, so we always subtract it, and this will give our closing balance. Okay, so the opening balance of our retained earnings is of 25,100. We're trying to calculate profit for the year. The dividend was of 22,000. So we need to subtract it. And for the closing balance, we can look at the changes. So we can see right here that there is an increase in retained earnings, which means that the closing balance is 9,600 higher than the opening balance. So 25,100 plus 9,600. And this results in the value of 34,700. Let's write it down. Now we can easily calculate profit for the year. That will be 34,700 minus 25,100 plus 22,000. This results in the value of 31,600. That is all for the second part. Let's move towards the third one. We now need to prepare the statement of cash flows for the year ended 31st December 2023 in accordance with IAS 7. Alright, remember that we are preparing for KPLC. We are preparing the statement of cash flows. And this is for the year ended 31st December 2023. Alright, we can first start with our cash flows from operating activities section. And the first item to be included here is profit from operations. Okay, we already have the profit for the year. Now, remember that to profit from operations, we subtract the finance charges as well as tax in order to get the profit for the year. We're trying to calculate this amount. So, profit from operations minus, let us first calculate the finance cost to be included within our statement of profit or loss. And in this case, we were told that the loan interest of 1,600 was paid. Now, for the finance cost, remember we need to make adjustment to the payment amount. We need to adjust for any accruals or prepayment of the interest. So we can start with the amount of 1,600. Now we know that at the opening date, we had accrued loan interest of 800. So opening accruals will always be subtracted. Then we were also told that there was an increase in accrued loan interest. It means that the closing balance of accrued loan interest is 600 higher than our opening balance of accrued loan interest, which is 800. This results in the value of 1,400. So we have the closing accrued loan interest of 1,400, which is to be added. This results in the value of 2,200. That is our finance cost. And in this case, no information regarding taxation is given, so we can just assume this to be 0 for now. And this results in the profit for the year of 31,600. So, profit from operations is just going to be 31,600 plus 2,200, which results in the value of 33,800. Okay, the next item to be included would be depreciation. Remember that this is a non-cash expense which was subtracted while calculating profit from operations, which is why now we need to add it back. And we've already calculated the depreciation amount for the year to be 28,800. After depreciation, we need to make an adjustment for profit or loss on disposal. In this case, we have calculated a loss on disposal. And remember, this loss was subtracted while calculating profit from operations, which is why now we need to reverse it by adding this amount of 2800. So we have loss on disposal of 2800. Okay. After this, we just need to make adjustment for changes in inventory, trade receivables, and trade payables. So you can see that there is a decrease in inventory, and inventory is an asset, right? So any decrement in asset will always result in cash inflow. So we need to add this amount of 2000. Then we have the increase in trade receivables, which is again an asset, and any increment in asset will be cash outflow, which is why we need to subtract the 7000. Then we have the decrease in trade payables, which is a liability. Any decrement in trade payables means that it is now cash outflow, which is why we need to subtract the amount of 1500. Let's write it down. So we first have the decrease in inventory of 2000, we add it. We then have increase in trade receivables, which was a 7000, we subtracted. Then we have decrease in trade payables, which was a 1500, we subtracted. And then we can calculate the cash flow from operations. So we just need to add all of these. That will be 33,800 plus 28,800 plus 2,800 plus 2,000 minus 7,000 minus 1,500, which results in the value of 58,900. Now, after cash flow from operations, we need to subtract the interest paid and tax paid. In this case, we do not have any information regarding tax, so we can just subtract the interest paid. We were given information regarding this. Right here, loan interest of 1,600 was paid. So we just need to subtract the amount of 1,600 now. And this will give the cash flow from operating activities. That will be 58,900 minus 1,600, which results in 57,300. Now we can move towards cash flows from investing activities. And in this section, we only include the purchase as well as sales of non-current asset. So we've already calculated the purchase value of equipment, that is 48,000. And remember, while purchasing, we need to pay cash. So this will act as our cash outflow, which means that we need to subtract it. Let's write it down. So we first have the purchase of equipment, for which we subtract the 48,000. Then we also had sale of equipment, and while making the sale, we received the sales proceeds, which will now act as our cash inflow. The sales proceed in this case was of 6,200. Let's add this amount. That will be all. Now we can get the cash flow from investing activities. That will be negative 48,000 plus 6,200, which results in negative 41,800. Now we can move towards cash flows from financing activities. Okay, so the first thing we had for the financing activities was the change in our ordinary share. And remember, there was no mention of bonus issue, which means that we can assume this 20,000 as well as this 5,000 was due to the proceeds of new shares. So that will be 20,000 plus 5,000, which results in 25,000. And since this is the increase in share capital, this will be additional cash flow into the business. So we can include this as part of cash inflows. Let's write it down. So proceeds from issue of ordinary shares, from which the company received 25,000. Then we also have an increase in 8% loan, which means that this was additional issue of 8% loan. And the company again received additional 10,000. So this will be another cash inflow. Let's write it down. This is issue of 8% loan of 10,000. Now, the last thing we need to include within the financing activities section is the dividends paid. And in this case, the dividends paid was of 22,000. The company is paying this, which means that this will act as cash outflow. So the dividends paid of 22,000 will have to be subtracted. And this will give us the cash flow from financing activities. So that will be 25,000 plus 10,000 minus 22,000, which results in positive 13,000. Now we need to calculate whether there was a net increase or decrease of cash and cash equivalents during the year. That will be the sum of these three values. So 57,300 minus 41,800 plus 13,000, which results in the value of 28,500. So this will be our net increase of cash and cash equivalents. The next thing we need to do is add the opening cash and cash equivalents. So cash and cash equivalents at the opening date is 1st January 2023, and then we can get the closing cash and cash equivalents, and our closing date is at 31st December 2023. Now let's take a look at the given information for the opening balance. Right here it's 38,900. Let's write it down. So 38,900, and the closing balance will be 28,500 plus 38,900, which is 67,400. Now, in order to check whether or not your statement of cash flows is correct, you can compare the closing balance to the given closing balance for the draft statement of cash flows. Because remember, this draft statement of cash flows was prepared by comparing the balance of each item. And the comparison balance of each item will show the correct net increase in cash and cash equivalents, which means that the closing balance will be correct, although the items included are incorrect. And the closing balance that we calculated from the corrected statement of cash flows was also 67,400, which means that the statement of cash flows that we prepared will have correct entries. So that is all for the third part of this question. Let's move towards the next one. And remember to show all of your workings within this box. And the workings will include the workings for your profit from operations, the workings for your purchase, depreciation, this accumulated depreciation, the working for your finance cost, working for the loss on disposal, as well as all of the workings regarding the net book values is the opening and closing date. And yeah, all of this should be shown within that given box for the workings so that you get your markings correctly. Okay, now for the fourth part, we need to analyze the changes in the cash position of Key PLC during the year 2023. So the first thing we can consider is the new loan, because Key PLC acquired new loan, and that will definitely increase the interest payable, which will reduce future profits. Let's write it down. Key PLC acquired new loan, which will increase interest payable and reduce future profits. Then we also know that new equipment was purchased. So we can see that that new equipment can increase the revenue generating ability of the company, which might result in increased future cash inflows. Let's write it down. New equipment was purchased, which increases the revenue generating ability of the company. So there will be an increase in future cash inflows. Nextly, we can compare the profit for the year and the dividends paid, because remember, dividend will be paid out of the profit made, right? And the profit for the year was of 31,600, whereas the dividends paid was 22,000. So we can say that the dividend amount should be reduced and the profit should be plowed back to the business for increased growth of the business. Let's write it down. Profit was of 31,600 and 22,000 was paid as dividend. The dividend amount should be reduced and the profit should be plowed back to the company for increased growth. Alright. Nextly, we also know that we sold the equipment, but there was the loss on disposal of 2,800. So in order to avoid this loss, the company could have kept using the equipment in order to generate additional revenue. Let's write it down. So equipment was sold at a loss of 2,800. To avoid this, the company could have kept using the equipment to generate revenue. Then let's take a look above. We can see that there was a decrease in inventory. It means that the company is now able to sell inventory faster. That's a good thing. Let's write it down. So let's write it down. Decrease in inventory means that the company is able to sell quickly. Now finally, we can also comment on the cash position. Let's take a look above. We can see that there was net increase during the year, and both the opening balance as well as the closing balances for cash and cash equivalents are positive. So net increase during the year and positive opening and closing balances of cash and cash equivalents indicate that KPLC does not have any liquidity problems. Okay, that will be all for the second question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.